In this chapter, we're going to discuss rewarding business performance. And as I've been thinking about this, we're really rewarding employee performance or rewarding employees for business performance. The story we'd like to use is about Larry Page and Sergey Brin and how they built Google from rank ordering random internet search results and how that was built up. Now, one of the challenges they continue to have now, almost 30 plus years later, is evaluating and rewarding employees and management for their performance. If you recall, one of the major objectives of management accounting is rewarding goal achievement. And so an accounting system will help with that in three ways. It helps to set the goals, helps measure performance, progress, and then it's instrumental in allocating rewards for achieving business goals and objectives. How does it do that? Well, great question. It starts by creating and setting goals, and if you covered our chapter on budgets, you can see that's also a way of allocating responsibility, measuring responsibility, setting up operations, but it also helps us set goals. And then we're going to use those goals and measure how well we did compared to those goals, and then provide some feedback to employees. So it essentially allocates resources to employees, then measures the results, and then uses that to reward for goal achievement. And so employees then are incentivized to provide services and make good decisions, work hard, and hopefully will be compensated for that. One of the first systems that is used was the DuPont system. So managers at DuPont wanted a method to help them set goals and measure progress. And so they began experimenting, and it all kind of started off with a measure of return on investment. What is the return, in this case operating income, to the resources or the assets you've been given? What is the return on that? So you have an endowment. You say, here are available resources that you manage, you control. And then what return did you get on that? And we use the DuPont system, and this is a measure of return on investment where we're evaluating how efficiently we're using resources through capital turnover, and that's sales divided by asset, typically sales divided by assets or sales divided by investment. And then that's going to be multiplied by some measure of return on sales. What are the earnings or what are the operating income divided by the sales that your division, your responsibility created. So as far as additional explanation here, capital turnover tells us how well the capital is invested, what type of sales dollars you're getting from every dollar of investment. The return on sales tells us what is the percent, what is the return, what is the operating earnings or the profitability that can be expected from each dollar of sales. Note that operating income, operating earnings, operating income is used because they have greater control over operating earnings than they do over net income, because net income can include interest and taxes that typically the manager does not have control over. So as far as this particular company, Bastille Company has two divisions, two managers over each division. And essentially we're seeing their operating performance, sales, cost of goods sold, operating expenses, and operating earnings, and their average capital invested. So we can take this 450,000, divide by 6 million, and get a return on asset. And then we can disaggregate that into two component parts: the return on sales or profit margin, capital turnover, sometimes called asset turnover. And we can see how this was made up. And so we could take 30%, multiply by 25%, and get 7.5%. But we're disaggregating ROI into its component parts. Okay, and the same thing we're doing here for the cookware division. 210 over 1.4 million. 210 over 400,000 is the return on sales. That's the margins they're getting. And the capital turnover, how fast they're turning over that capital. Okay. So now let's go to year 2 and take a look at this for Bastille. And so you can see there was a change. So let's just kind of go back and forth for a minute. Sales were 1.5, went to 1.7. Earnings went from 450 to 530. And so we can see how well they performed the next year and why they performed at that level. So here, the fine china division got 8.55% and cookware got 15%. And you can see similar from year to year, not huge change, but we can see how that occurred by looking at the disaggregation between return on sales and capital turnover. So we can see how that goes. So let's do a little more diagnosis here. Results for the fine china division year 1 show return on sales of 30%, or each dollar got 30 cents of earnings. The cookware division, each sales dollar generated 52 cents of earnings. Okay, so to have an impact on return on sales in years 2, a division manager would need to reduce cost of goods sold. Okay, and that would not have any impact on revenue or increase revenue without a proportional impact on expenses. So we've got to change one of these, either reduce cost of goods sold for greater income or increase revenue without proportionally increasing expenses. So now we look at year 2 and we see they were able to increase revenue from 1.5 to 1.7, and cost of goods sold did increase, but the increase was smaller than the percentage increase. So we can explain why that happened. So revenues increased 13.3%, but cost of goods sold only increased 12%. So they would have a greater margin. So let's look at this return on sales. So we went from 7.5% to 8.55%. And why was that increase? Well, return on sales went from 30% to 31%. So it might be viewed as modest, but still an improvement, and that helped improve our return on investment. Okay, so we're able to see exactly why that happened. Now, the cookware division did not do as well. They had a drop from 52.5% to 51%, and so we're exceeding why that happened in the return on sales. And so while revenue didn't increase at all, cost of goods sold did increase, and that means operating expenses increased as well. So, assume you're a manager of the cookware division at Bastille. Your boss has criticized your division's performance year 2, specifically targeting the return on sales. When planning your operating budget for year 3, what strategies might you consider? Okay, so how are we going to reduce expenses? Is there waste in our production process, in our sales process? What are we doing? How can we decrease operating expenses and thus increase operating earnings? And so we need to look for ways to do that. The other half of this is capital turnover. So if we are here looking at the fine china, that first division, we see that sales increased 13.3%, but capital only increased 3.3%. So looks like good news, right? Because we got better turnover. We had more sales without increasing capital so much. Okay, and so we're able to see that performance. All right. So, international case in point, surveys comparing Australian and Japanese companies' use of divisional performance measures show that fewer Japanese companies use ROI compared to Australian and US. So you can see where the emphasis is. In Japan, the emphasis is on the return on sales, but with a strong focus on growing market share. So they're more interested, more concerned about growing market share, whereas, and that would probably be viewed as a longer term approach, whereas Australia and the US, which we might call Western, would be more focused on pleasing stockholders rather than growing market share. So we can see those differences. Well, as you can guess, return on investment does some great things, but there are also some concerns, some criticisms. And so what we're trying to do is motivate employees to make decisions consistent with their goals. However, managers who are measured and rewarded only on their division's ROI may decide to increase profits and decrease capital in their divisions, but not care about the best interests of the whole company. And so they may be pushing off capital or increasing profits that cost the rest of the organizations. There's basically three criticisms we want to talk about. Here they are. The first criticism, that it's a short horizon problem. Okay, so what is the goal of a firm? Long run profits, typically. And ROI says, hey, what can I do this period, this year, this quarter, so that I can get a bonus? But maybe not concerned about prepping something for the future, setting up long-term profitability. So that's a concern. The second concern is it presents an incentive for a manager to reject a good project that would increase ROI for the firm as a whole. Again, if they are only interested in looking at their division's ROI rather than the ROI for the firm, that's not helping the overall business. So if they're not undertaking a project that would ultimately reduce ROI for some divisions but help their division, that's not going to contribute to the overall ROI of the business. So it almost seems like you need to both incentivize your division performance at the same time as looking at the overall business at the same time. Okay, the third criticism. It is inherently difficult to measure both the average invested capital and the actual operating earnings associated with that capital. Okay, so capital is given or allocated between the two divisions, in this case the cookware and the fine china, but it's not always clear. I mean, in this case it talks about an R&D facility. Are they going to do R&D for cookware? Are they going to do R&D for fine china? Do they divvy it 50-50? How are they going to allocate that R&D facility between the two divisions that make sense? And so this is a constant struggle to say, okay, what belongs to who, and try to look at that. So to address these concerns, these criticisms, other financial-based business performance measures have been created. One is residual income, the other is economic value added. So let's go through them. They do not suffer from the same horizon and underinvestment criticisms attributed to ROI. Remember, ROI, which we just mentioned, has relatively short-term horizon and sometimes leads to underinvestment. Okay, so first let's talk about residual income. Residual income is the amount by which operating incomes exceeds a minimal acceptable return. So here's our operating earnings, and we need to create residual income, and it's the extent to which operating incomes exceeds some minimal acceptable return, essentially the cost, or sometimes called the cost of capital, or required rate of return, some minimum times the invested capital. And so we're going to measure that and use that measure to reward business performance. So let's use an example. Okay, so manager of the cookware division looked like they decided not to invest. The expected operating earnings for the project was $55,000 on invested capital of $500,000, or an expected ROI of 11%. Okay, so $210,000 was the return without this project, and their minimal acceptable rate of return is 10% on the invested capital. Okay, so now if we take the 210, add the 55,000, we're expected to get 10% of ROI with the project, residual income with the project would be 75,000. So we see we're adding this $500,000 investment here to the capital. As long as we're expected to get 10%, but we're making 11% on this, so the residual income increases. So that would be suggest more motivation to take on this project. So you can see how residual income might be used. The other is economic value added. So economic value added refines the residual income measure, and so you can kind of see some similar attributes here where we're taking after-tax operating income. Okay, first of all, notice it's after tax, but we're going to subtract the division's total assets less the division's total liabilities. Okay, so that's kind of what the net resources are that are available, and we're going to multiply that by the weighted average cost of capital. And we'll think of weighted average cost of capital as some minimally accepted rate of return. Okay, and so we're saying, all right, let's see how the extent to which the after-tax operating income exceeds the net resources. This would be kind of a working capital measure times the weighted average rate of return. So we can see what this looks like, and this is another measure that has been used. The next thing we want to talk about is balanced scorecard. So for the cookware division, we have a supplier, goes to the cookware division, from the cookware division to the wholesaler, to the retailer, and ultimately to the customer. We hope that in each stage, or we need to evaluate in each stage if we are creating value in this value chain. Okay. So as we talked about the balanced scorecard, we're trying to link the company strategy to specific goals and objectives. What I get mostly out of the balanced scorecard is we're trying to measure more than just financial performance. And so we're trying to look at a balance of a bunch of performance measures. And so let's look at what those might be. So financial is still there. But our vision and strategy is not just financial. It is to, serve our customer. It is to continue to learn and grow. I mean, be it R&D, be it employee training. It is to have high quality processes that are efficient and effective, in addition to a financial perspective. So we're trying to do all of those. And so what we're trying to do is provide measures. Sometimes we call these KPIs, key performance indicators, from a financial perspective. Okay, so what we've just talked about here, ROI, ROS, economic value added, residual income, etc. Okay, from a customer perspective, how are we going to improve these relationships? How are we going to get them to increase their orders, especially from the most profitable customers? So we have some measures here. We also have a business process perspective. We're trying to improve our relationships with our supplier, particularly for this cookware division. We're trying to improve our communication, our relationships, improve our processes, our manufacturing, where scrap is low, quality is high, percent of orders filled, number of on-time deliveries. So all of these processes from a business perspective. And then learning and growth. We want to not only improve retention, but we want to train them, right? And so we want them to have what they need. They need to see growth opportunities. They need to see, what they can become. And also increase new product development. So R&D, that we're continuing to make a better product. And so each of these has measures that we want to consider as part of the balanced scorecard. So again, now financial perspective. What is the return? And this is kind of what we've been talking about earlier on here. What's the ROI? What's the return on sales? What's the capital turnover? What's residual income? And make sure, typically traditional financial measures that are used. Customer perspective. How are we serving the customer? Looking at customer satisfaction, customer quality. Is our market share growing? And so this helps us think longer term rather than just immediate financial results. Helps us think about the customer. The next perspective is the business process perspective. Are we reducing the amount of scrap, our downtime, reducing the number of warranty claims? Do we have good relationship with suppliers and measuring those relationships? And then learning and growth. taking care of our people, taking care of our employees, giving them a path that they can see themselves in the organization, and making sure that they have the training they need to be successful, and really looking at how we're growing and learning as an organization, including R&D. Are we making new products? Are we making these to ensure the success in the future of our organization? And as always, there are some challenges. One of the challenges is, hey, now we have a bunch of KPIs, and we don't know exactly how to weight these things. Should these all be completely balanced, like 3 metrics of each for each of the 4 perspectives? And at some point there becomes so many measures, so you can see, because of the large number of performance measures, it's unclear what to do. So really, the nice deal about a financial perspective is there's really one thing to focus on, but we might become hyper-focused on that, and that might become an issue in the future. And we might spend all of our time and expense maintaining and operating a fully designed system, and so much effort on designing the system and less effort on actually performing and keeping balance with the organization on these 4 perspectives. So, your turn. You're manager of a BCD company, and you're supposed to design a balanced scorecard. In particular, you've been asked to suggest measures that could be used to evaluate purchasing activities. You've seen the consultant reports. You realize there's measures they suggest be tied to your bonus each year. Your department has been collecting benchmark information about the suppliers used by other purchasing departments. You're aware that your department has been choosing higher price suppliers because of higher quality. All right, so what measures would we suggest? So some of the problems or some of the issues is collecting benchmarks of others that have maybe a different strategy. Do we need to be choosing lower price suppliers? How important is the quality? How do we measure that? How do we compare and contrast with others? How do we set this up for the bonus? And so these are good measures. So let's go back and look at the supplier perspective here and the supplier metrics. And so let's see, improve supplier relations, number of qualified certified suppliers, number of vendors, percent of on-time deliveries. How do we measure those? Are those good measures? How do we measure how important the quality is to us? How has this affected our financial perspective? So you can see there's a number of perspectives that can be used, and one of the challenges is when we start comparing to others that have maybe a slightly different strategy is, how do we compare to them? How do we compare and contrast that? Our last topic of discussion is components of management compensation. Usually there are 3 types or 3 components to management compensation: a fixed salary, a bonus, and other types of incentives. So the fixed salary, hey, this is what you're going to get regardless of performance, but you got to keep your job. If you hit certain benchmarks, or if the company hits certain benchmarks, you have a certain return on investment, you might get some cash or stock options. And there might be other types of incentives. For example, a life insurance policy, use of an automobile, use of aircraft, use of an apartment. And so you can see these different ones. So as we think about how we want to incentivize management, we think of the design choices. Okay, what should be the time horizon? We mentioned earlier in this lecture that the time horizon sometimes is too short. So how do we make it longer but still incentivize? How about the fixed versus the variable bonus? Okay, so the fixed salary versus a variable bonus. Okay, choice of stock versus accounting-based measures. So, hey, what has been the stock market return? What has been the accounting performance? How do we balance those? Choice of rewarding local, your own division, versus company-wide performance. So some of the concerns expressed earlier were sometimes these measures, or sometimes the issue is that we're just looking at our division, which might not benefit the company as a whole. So do we do 50-50 between local, your own division, and company-wide? or some other weighting, and choice of cooperative versus competitive incentive plans.